Good morning to everyone, and thanks again for joining us for Tecnoglass's quarterly earnings report. We're again pleased to report record results across the board in essentially all financial metrics: revenues, gross profit margin, operating revenues, backlog. So again, the trends that we have been discussing continue. We see a lot of robust demand and strong momentum on the commercial side, which is picking up nicely. But Q1 results were driven again by healthy growth on the single-family residential segment, which grew 155% year over year. Our backlog continues to grow, especially now that we're seeing commercial construction coming back. And within commercial construction, it's important again to know that most of what we do is multifamily, which is an area that is outperforming others like office space and hospitality. And even within that, it's important to know that a lot of our exposure is into the Southeast, which is a geography that is experiencing better secular trends with people migrating down south and companies relocating. So we were very pleased to again report a record level of backlog and a healthy pickup year over year in advance of what we see for the rest of the year and now for 2023 and almost 2024 here pretty soon. So honing in into the residential segment, as I just mentioned, we grew that portion of the business 155% to a record level of almost 60 million for the quarter. The growth on single-family residential is really more of our continued push into different geographies now throughout Florida and pushing into Texas, where we already got a couple of projects, and pretty soon looking to get into the rest of the Southeast. So it's organic growth. We're taking market share from others, and we'll go into the details as to why. And the introduction of the Multi-Max product for home builders, which continues to trend up. So that's been a nice story. And it's important to highlight that roughly 65% of that business is related to repair and remodeling, which is clearly not as tied up to interest rates as new home construction. So when people start thinking about how things are changing because interest rates are going higher, this does not necessarily impact our business fully as those that are exposed 100% to new home construction. So this is a nice area that we expect to continue growing and be the main driver of growth for 2022. On the competitive advantages that we highlighted in the past few quarters, we continue to see the same. Inflation continues to be a big issue for some of our U.S. peers, mainly labor inflation, raw material inflation. And we touched on the fact that, number one, we do not encounter labor inflation by being positioned in a different market, right? I mean, Colombia has an ample supply of labor, unemployment rate of 12%, and we're just not seeing the same labor dynamics as some of our U.S. peers are seeing. And as it relates to raw material inflation, as you know, we're fully vertically integrated. We have a joint venture with Saint-Gobain to supply our glass. We have hedged our aluminum needs. So we're just not seeing the same headwinds as some of our U.S. peers are. And that has allowed us not only to continue pricing competitively, but delivering best-in-class lead times, which right now is a huge differentiator. And we have been able to stay around the same lead times as pre-COVID, talking about 6 to 7 weeks versus up to 20 weeks for some of the other players in the US. So that continues to provide ample benefits and new opportunities for us. From a revenue perspective, the growth was 20% year over year. 94% of our business continues to be the US and growing. And that's where we expect the continued growth to come from, where we're seeing a lot of demand for commercial construction. If you look at the ABI indicator, it came out at an almost all-time high in the last reading, and we're actually seeing that on the ground as well. And within the US, again, the Southeast continues to outperform. So we're seeing a lot of demand on the commercial front. And on the resi side, we continue to see growth, as we just discussed. So that's what's driving revenue growth. And if as we're going to discuss on our new guidance, we continue to see that ramping up as we move into the year. From an adjusted EBITDA perspective, we reached a record level of 45.3 million for the quarter, driven by the best gross margins that we've had in the history of the company, almost getting to 45%, driven by different factors that we're going to discuss here in a little bit. But that's driving increased profits, and we have now a new kind of base case for gross margins to approach low 40s for the rest of the year, which is going to drive incremental adjusted EBITDA for 2022, as we'll discuss in the new guidance and the new outlook for the year. From a balance sheet perspective, our balance sheet continues to be in a very healthy position. Leverage continues to trend down, now standing at 0.6 times. We just repaid 15 more million of debt as of March, and that's placing us at the lower part of our leverage grid at LIBOR plus 150. So again, that's driving efficiencies and incremental profit as our interest cost continues to trend down. And we continue to have ample flexibility with about 250 million in committed lines in cash, which stayed the same at about 85 million at quarter end, despite having paid the 15 million in debt that I just discussed. So we're in a very good position, a healthy balance sheet to continue executing our growth strategy. As I mentioned, growth drivers hit an all-time high, and there are three main structural and sustainable advantages that we have and drivers of best-in-class gross margins. Obviously, you get operating leverage on the business, and we expect to continue getting that. We are getting better margins from the single-family residential segment where we do not do installation. So that's also helping with that, and that's sustainable because we expect to continue growing on that segment. And finally, the automation that we invested on over the last couple of years, which basically drives significant enhancements and benefits because we're able to optimize labor count, and we are able to reduce raw material waste. So we expect, as I just mentioned, new gross margins to be in the range of the low 40s. From an outlook perspective, based on everything, we have just re-guided upwards, and now we expect revenues to be 580 to 605 million, up from 575 to 600. And as a result of better than expected margins, we're increasing our adjusted EBITDA guidance to 185 to 195. And this is up from 175 to 185. So expected growth, and we continue to trend in a positive way as we go through the year. Again, thanks for joining us, and we hope to see you in the next call. Thanks a lot.